Turning a small investment into serious money isn't luck, it's strategy. But here's the thing. Most beginners waste years using methods that don't work. What if I showed you exactly which investing strategies actually deliver results, and how you can pick the right one for you? My name is Alex, and today I'm sharing the top 5 investing strategies that consistently perform no matter what the market is doing. Now, the first strategy might shock you because it's incredibly simple yet highly effective. Have you ever wondered why some investors steadily grow their wealth, even in bad markets, while others lose money despite doing everything right? Stick around. I'm about to reveal their secrets shortly. The first proven strategy is buy and hold investing. Now, this might sound basic, but there's a powerful twist most beginners miss. Buying and holding isn't just about patience. It's about carefully selecting high-quality companies or index funds and committing to hold them for years, sometimes decades. The magic here is that your investments benefit from compounding growth, which is your returns making even more returns over time. But wait, how exactly do you know which stocks or funds to buy and hold? The safest bet for beginners is investing in index funds or ETFs, tracking broad markets like the S&P 500. History shows these funds consistently outperform actively managed portfolios long-term. It's basically a stress-free, set-it-and-forget-it strategy that lets you sleep easy at night. Sounds great, right? But here's a big question. What if you want quicker returns or have different risk tolerance? Are there better strategies tailored specifically to your needs? That brings us to strategy number 2, dividend investing. Dividend investing is all about buying shares in stable, mature companies that pay consistent dividends. Imagine getting paid regularly just for holding certain stocks. It's passive income at its best. Here's the kicker. Many beginners completely overlook how powerful reinvesting dividends can be. So, how can you practically use dividends to create reliable income and accelerate your portfolio growth? The key is reinvesting dividends instead of cashing them out. Every dividend payment buys you more shares, and those additional shares generate even more dividends, creating a snowball effect. If you like the idea of your investments literally paying you while you sleep, dividend investing could be your perfect match. But maybe you're thinking, this sounds safe, but what about maximizing returns faster? Great question. If quicker growth appeals to you, consider our third powerful strategy, growth investing. Growth investing means buying stocks and companies expected to grow rapidly. Think about companies like Tesla or Amazon in their early days. Investors who got in early multiplied their money many times over. But here's the catch. These companies often don't pay dividends, reinvesting all profits to fuel expansion. So how exactly do you spot a future Tesla or Amazon before everyone else? Look for innovative companies dominating new or growing industries, with strong competitive advantages and visionary leaders. Yes, growth investing involves more risk, but the potential rewards can be life-changing. But wait, what if high risk isn't your style, yet you still want decent returns without losing sleep? Then strategy number 4, value investing, is your answer. Popularized by legendary investor Warren Buffett, value investing involves finding stocks that are undervalued by the market but have strong fundamentals. Essentially, you're bargain hunting. You're looking for great companies temporarily facing bad news or market conditions that drive their prices below fair value. But how can beginners easily identify these undervalued gems without needing a finance degree? Simple. Focus on companies with consistent profits, low debt, and strong competitive positions whose stock prices recently declined. Often these temporary setbacks cause investors to panic, creating amazing buying opportunities for smart value investors. Now, before you decide value investing is your best bet, there's another powerful yet overlooked strategy perfect for those who prefer automation and minimal effort. It's called robo-investing. Robo-advisors use algorithms to automatically build and manage diversified portfolios tailored specifically to your risk tolerance and goals. You simply set your preferences, deposit money regularly, and let the robo-advisor handle the rest. It's truly effortless investing for busy people who still want solid returns. But are robo-advisors really as good as human advisors, and can you trust algorithms with your money? Here's the surprising truth. Research shows robo-advisors often outperform traditional advisors over time, thanks to low fees, automatic rebalancing, and zero emotional bias. If you love the idea of a hands-off approach, this might be your ideal strategy. But here's another critical question. How do you pick the perfect strategy for your unique situation, goals, and personality? The answer lies in clearly understanding your personal risk tolerance, investing timeline, and desired level of involvement. Ask yourself honestly, how comfortable are you with risk? Are you investing short-term for a big purchase or long-term for retirement? Do you prefer hands-on control or passive simplicity? But here's something most beginners don't realize. The best investors often combine multiple strategies. Imagine mixing dividend stocks with growth stocks or blending robo-advisors with occasional value investments. Diversifying your approach can supercharge your portfolio growth while reducing overall risk. So now you've got a clear picture of these 5 powerful investing strategies: buy and hold, dividend investing, growth investing, value investing, and robo-investing. But here's one last critical insight that could transform your investing journey forever. Knowing these strategies is pointless unless you take action. So how exactly do you move from theory to practical steps? And what's the smartest first move you can make today? Stick around. I'm about to give you a simple yet highly effective step-by-step blueprint to immediately start using these strategies successfully. The smartest move you can make right now is deciding exactly which of these strategies aligns best with your personal goals and comfort levels. But here's something critical most beginners overlook. No single strategy works perfectly for everyone. So, how can you quickly identify your ideal investing strategy without getting overwhelmed? Step 1. Think about your investing timeline. If you're young and have decades ahead of you, growth or dividend investing can give you powerful compounding growth. If you're closer to retirement or need funds soon, value or dividend strategies offer safety with solid returns. But what if you're somewhere in between or unsure about your timeline? In that case, step 2 is crucial. Consider your risk tolerance. Can you sleep at night knowing your investments might swing significantly day to day, or do you prefer stable and predictable growth? If volatility stresses you out, dividend investing, value investing, or robo-advisors are perfect. But if you're comfortable with market swings and want rapid potential gains, growth investing could match your personality perfectly. Now, step 3 is deciding how involved you want to be. If you love researching companies and picking individual stocks, growth or value investing might excite you. But if you'd rather spend minimal time managing your portfolio, robo-advising or a simple buy and hold strategy with index funds is ideal. So, here's the critical question. What if none of these strategies feel exactly right on their own? Here's where the magic happens. Remember, combining strategies can deliver the best results. For example, blending dividend investing with robo-advising can provide reliable income while minimizing hands-on effort. Or pairing value investing with growth stocks might offer stability plus higher potential returns. Mixing strategies doesn't complicate investing, it simplifies and optimizes it. But how exactly do you practically implement this combined approach without confusion or mistakes? It's simple. Start small. Begin by clearly defining your primary strategy, then add a secondary strategy gradually as your confidence grows. For instance, start with a robo-advisor or ETF portfolio, then slowly add dividend or growth stocks over time. Remember, clarity beats complexity every single time. The biggest mistake beginners make is jumping in too fast with multiple complicated strategies. Keep it simple, start slowly, and expand only when you're comfortable. So now you know exactly how to pick and implement investing strategies that actually deliver results. You've learned buy and hold gives you steady compounding growth with minimal effort. Dividend investing provides reliable passive income and wealth accumulation. Growth investing offers potential explosive returns. Value investing allows you to profit from undervalued opportunities. And robo-advising makes investing easy, automatic, and stress-free. Here's one last important insight. No strategy works unless you stick with it consistently over time. Too many beginners panic sell when markets dip, ruining their strategy. How can you avoid this costly mistake? Always keep a long-term perspective. Remember, temporary downturns are inevitable, but historically, markets always recover and move higher. Stay calm, remain consistent, and let your chosen strategy work for you. Ready to take action? The best first step is choosing a brokerage account that aligns with your chosen strategy. Look for platforms with zero commission fees, easy interfaces, automatic investing features, and educational resources tailored specifically to your approach. Imagine confidently watching your investments grow because you've picked strategies you fully understand and trust. That's the power you now have. But here's one final challenge. Are you ready to put these proven strategies into action immediately? Or will you let another year pass without growing your wealth? Your financial future depends on your next move. Make it count.